Namaskar. I am Dr. Swapna Pillai, Associate Professor, Department of Commerce here at the Bhopal School of Social Sciences. Today, we are going to discuss the topic Consolidated Balance Sheet or Holding Company, Subsidiary Company together with Balance Sheet. What are we going to study today? We are going to understand what is consolidation. We are going to look at the meaning of the term holding company, subsidiary company. We are also going to look at the membership of the holding company. We will try to understand wholly owned and partly owned subsidiary company. And finally, we will also look at the preparation of the consolidated balance sheet, the rules regarding the preparation of consolidated balance sheet. So let us start to understand what is the meaning of consolidation and why the company needs to go for consolidation. A small business owner typically needs a diverse set of skills to succeed, including deep market knowledge, effective management, and hard work. One way to increase sales and profits is through a process which is called as business consolidation. This process is designed to lower the overhead and the production costs, create additional revenue streams for the company, attract skilled managers, and also achieve economies of scale. Consolidation can take place through acquisitions, mergers, gaining control by one company over other companies, etc. Formation of holding company is one of the most popular methods of achieving these objectives. What is a holding company? Holding company is one which has one or more subsidiary companies and enjoys control over them. Legally, holding company and its subsidiaries, they have distinct and separate entities, but in practice they work in group and collectively they are called group of companies. Under Accounting Standard 21, holding company has been termed as parent enterprise, and it has been defined as an enterprise that has one or more subsidiaries. Now, what is a subsidiary company? A subsidiary company, according to Section 287 of the Companies Act 2013, subsidiary company or subsidiary in relation to any other company, that is to say a holding company, means a company in which the holding company controls the composition of board of directors or exercises or controls more than 1/2 of the total share capital, either on its own or together with one or more of its subsidiary companies, provided that such class of holding companies as may be prescribed shall not have layers of subsidiaries beyond such numbers as may be prescribed. According to Accounting Standard 21, a subsidiary is an enterprise that is controlled by another enterprise, which is known as parent company. Now, let us look at the membership of holding companies. A subsidiary company cannot become a member of its holding company, and in this context, any transfer or allotment of shares by the company to its subsidiary company is considered void. What are the rules? A subsidiary company may hold shares in the holding company as a legal representative of the deceased member of a holding company or as trustee, unless the holding company or any subsidiary thereof is beneficially interested under the trust concerned. A subsidiary may continue to be a member of the holding company if it was a member thereof at the commencement of the Act or before becoming a subsidiary of the holding company. In such a case, the subsidiary shall not have any voting right in respect of the shares held. Now, let us try to understand the types of subsidiaries. There are two types of subsidiaries: wholly owned and partly owned subsidiary company. What is wholly owned subsidiary company? A wholly owned subsidiary company is one in which all the shares with voting rights of 100% are owned by the holding company. In partly owned subsidiary company, only the majority shares, that is more than 50%, are owned by the holding company. That is, all the shares of the subsidiary company are not owned by the holding company. In such a subsidiary company, minority share exists as less than 50% shares with voting rights are held by outsiders other than the holding company. Now, let us look at the preparation of consolidated balance sheet. The first point is elimination of investment. Investment in the shares of subsidiary company is shown in the asset side of the balance sheet of the holding company, whereas capital is shown in the liability side of balance sheet of the subsidiary company. These two items are mutually adjusted as follows. Preparation of consolidated balance sheet on acquisition of all the shares. When holding company acquires all the shares of the subsidiary company, then following description is irrelevant at the time of preparing the consolidated balance sheet. If the holding company acquires all the shares of the subsidiary company at par value, what happens? If holding company has taken over all the shares of the subsidiary company at par value, then holding company becomes owner of all the shares of the subsidiary company. All the assets and liabilities of subsidiary are added respectively in the assets liabilities of the holding company, and this is why it is called as consolidated balance sheet. If the shares are acquired at premium, then what happens? When holding company purchases all the shares of subsidiary company at a premium, that is more than the actual value, then this premium is shown as goodwill in the asset side of consolidated balance sheet if contrary information is not given. Acquisition of shares at discount. When holding company purchases all the shares of subsidiary company at a discount, then the price paid becomes less than the value of net assets of the subsidiary company. In the absence of any different information, this difference is shown as capital reserve in the liability side of consolidated balance sheet. If old goodwill is given, then this capital reserve is adjusted in the old goodwill. Acquisition of shares of one subsidiary company at a premium and of other subsidiary company at a discount. When holding company acquires the shares of one subsidiary company at a premium and the other subsidiary company at a discount, then in this case, if the amount of premium is more than the discount, the excess premium is shown as goodwill in the asset side, and if discount is more, then excess discount is shown in the liability side as capital reserve. This is all about acquisition of shares. Let us now discuss point number 2. Determination of goodwill or cost of control or capital reserve. The cost of acquisition of shares in the subsidiary company rarely agrees exactly with the intrinsic value of shares, that is, the net assets of the subsidiary company on the date of acquisition. Now, if the purchase price, that is the cost which is paid by the holding company for the shares acquired in the subsidiary company, if it is more than the intrinsic value of shares acquired, the difference should be treated as cost of control or goodwill. If, on one hand, the purchase price paid by the holding company for the shares acquired in the subsidiary company is less than the intrinsic value of shares acquired, the difference shall be treated as capital profits and it is credited to capital reserve. It should be noted that while computing the intrinsic value of shares as on the date of acquisition or control, all profits and losses up to that date have to be taken into account. To understand this, let us look at an example. Before looking at the example, let us look at the formula for calculating goodwill or capital reserve. Calculation of goodwill and capital reserve. First, purchase price of shares of subsidiary company is taken. From that, we deduct book value of the acquired shares of subsidiary company, shares of holding company in the reserves of the subsidiary company for the pre-acquisition period, shares of holding company in the funds of subsidiary company for the pre-acquisition period, the shares of holding company in the profits of the subsidiary company for the pre-acquisition period. If the net amount is positive, then it goes to goodwill. If it is negative, then it goes to capital reserve. Let us look at an example to understand this formula or calculation of goodwill or capital reserve. H Limited has acquired shares in S Limited on 31st March 2014. The balance sheet on this date was as follows. Equity and liabilities. Under that, we have shareholders fund. Under shareholders funds, we have share capital. In share capital, we have shares of rupees 10, which is fully paid shares. We have two companies, H Limited, the company which is going to acquire the S Limited. So, H Limited is holding, S Limited is subsidiary. H Limited share capital is 1,20,000. S Limited share capital is 60,000. Reserves of H Limited is 30,000. S Limited is 15,000. We have a statement of P&L which shows a surplus. H Limited is 20,000. S Limited is 15,000. Under current liabilities, the trade payables of H Limited is 1,05,000 and S Limited is 30,000. So the total of liabilities is 2,75,000 for H Limited and 1,20,000 for S Limited. The assets, the sundry assets of H Limited is 2 lakhs. The sundry asset of S Limited is 1,20,000. The investments of holding company in the subsidiary company, that is investment in 6,000 shares of S Limited, is rupees 75,000. Now this is the investment made by the holding company in the subsidiary company, which would be used in the calculation of goodwill or capital reserve. The total assets is also the same as liabilities, 2,75,000 for H Limited and 1,20,000 for S Limited. Now let us look at the solution. Calculation of capital reserve or goodwill. Cost of investment is 75,000. The face value of the shares is 60,000. Now, cost of investment is the investment made by the holding company in the subsidiary, 75. The actual face value of that shares is 60,000. The reserves is 15,000. The P&L surplus is 15,000. So, when we total these three, it is 60 plus 15 plus 15, which is 90. And the cost of investment is 75. So, we have an amount of 15,000, which is showing negative. That is, purchase price is less than the actual value of shares and reserves of the subsidiary company. So here we have a difference of 15,000. This goes as capital reserve. Had this amount been positive, this would have gone as goodwill. So today in this module, we have tried to understand what is consolidation, the meaning of holding and subsidiary company, what are the rules for membership in the holding company, the wholly owned subsidiary company, the partly owned subsidiary company, and some of the methods for preparation of consolidated balance sheet. In the next module, we will discuss the remaining aspects for preparation of the consolidated balance sheet. Thank you.